G'day and welcome back to our series on end-of-year financial strategies and considering your superannuation and what strategies can be implemented to reduce your tax both now, this financial year, and potentially on into many years to come. My name is Robert Gowdy from Consortium Private Wealth, and this video we're going to have a look at non-concessional contributions. So essentially, non-concessional contribution is your money that's been saved up and you've already paid your tax on, so it's after-tax money going into superannuation. And like the concessional contribution, there are limits on how much you can put in each year, and that is $100,000 per annum of non-concessional contributions. There is the ability to bring 2 years forward and put 3 lots of contributions in a single year. So that's called the bring forward rule, where we're in, say, 2020 financial year now, we bring forward 21 and 22 and put $300,000 in one financial year. Now, you need to be under age 65 to be able to do that. There is potential legislation change that might up that to age 67, but at this stage you need to be under age 65 to use the bring forward rule. For those that are aged between 65 and 70, obviously it might be a slight change coming forward, but you're unable to use the bring forward rule, and you must obviously meet the work test, which is working 40 hours over a 30-day time frame before you make a contribution into superannuation. Now, the reason why you might want to get larger lump sums that are not sitting with a super right now is obviously the superannuation tax considerations. That once money's in superannuation, the maximum tax rate they'll pay is 15%. And once you're retired or age 65 and you move to an account-based pension, up to $1.6 million in pension will be completely tax-free. The pension that gets paid out to you is tax-free, and the income the fund receives in the fund itself is tax-free and not taxed at the normal 15% you'd normally pay on an accumulation account. So really beneficial. We have lots of people coming to us at the moment, particularly given the extremely low interest rates. They're interested to know what other options they've got, and superannuation is one of those options as a great tax structure. And then we're investing within there to hopefully over the longer term get a much better return. Now, once people get over a certain amount of money, that's $1.4 million, we need to be a little bit careful the amount that we contribute, because we are only allowed to have up to $1.6 million as a total super balance. So we need to make sure that once you get to 1.4, there are limitations, particularly with regards to the bring forward rule. So once you get to those limits, make sure you seek professional qualified advice to make sure that you're not going to breach those limits. But this is a great way to get a lot of money in a very concessionally taxed environment, where your money can still be invested exactly how you want, even if it is still a term deposit or more of a balanced fund that will give you a higher return over the longer term. From a tax point of view, a brilliant spot to be, and that's why you'd use non-concessional contributions. Thanks for listening. The next one we'll cover off in this video series, it will be the government's co-contribution. Thanks for listening. Speak to you soon.